Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, December 20th, 4:35 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a correction. You can see over here on the trend gauge, things have been getting progressively worse over the last week since the Fed announcement last week, and we had a negative reversal off CPI. Finally got a selling reprieve today. But taking a look at the trend gauge, leaders still neutral to negative. Short term, all five major indexes below their declining 21-day exponential moving average. Medium term, a little bit of a mixed bag. The slope of the line still up, but for the five indexes below their 50-day moving average, that's our medium term line. Long term, only the Dow remains above the 200-day moving average slope of the line down there. So what happened today? Finally, after 4+ days of selling off the top on the CPI gap up, we had the selling kind of dried up today. Tight consolidation day, finished mixed, but we tried to get down early in the morning, and actually we were down overnight. We made a new low, 37.76. On the S&P. We'll talk about that when we go to the tail of the tape, but the print low just below that 3,800 level. So that seems to be holding up for now. So on the day, G6 up about 0.4%, S&P 500 gap down 0.25%, ended up, but like I said, put in the low within the first 30 minutes, and then trended higher, and then really chopped all day, up about 0.1%. Still capped on the upside. Sellers appear, but on the downside, buyers showed up underneath 3,800 today. Nasdaq 100 down 0.1%. Dow up 0.3. Mid caps up 0.5%. Russell up 0.5%. Global diversified 60/40. Stock and bond down 0.13% as bonds took it on the chin today. GROTECTION in-house, we were slightly positive, up 0.05% approximately. We'll go through the tail of the tape and charts in a moment after I give my public service announcement about what we do here at Revere. Protecting the downside is our number one priority at Revere. You protect the downside, gains take care of themselves when the market gets back to a healthy posture. Uh, we've studied bear markets a lot. You do not want to get caught in a bear market when you're approaching retirement. January to October this year, 27.5% loss. You need 38% to get back to even. We're still, we rallied up to negative about 15%, 16%, back down in around 19.8%. Again, now year to date. But that's a lot better than some of these other numbers that you can get caught at. And keep in mind, the market is pricing in a recession, the bond market anyway, pricing in a recession next year. Uh, 1 year of losses like this is bad enough. 2 years can derail retirement plans. So that's why our approach is safety first when we get under this key level, this black line, this 200-day moving average. All the bear markets I just showed, they all take place there. On average, when a market tops, it's about 12% down to the 200-day moving average. That's about what we're down year to date. That's normal and easy to come back from. It's the 20s, 25, 30, 35, 40% losses that are dream crushers. So when we're trending nicely above all the moving averages, we are fully in the market. When we start to roll over, or the slopes of the lines of the moving averages roll over, that says, well, this might not be a pullback, this might be a correction. So we lighten up there, we get below the black line, we get fully defensive, and then we've got rules to get back in, primarily dealing with shakeouts like we saw on 1013, and also getting back above the green line, the 21-day moving average. That's our short-term trend line, which we trended nicely above at the beginning, off the low, had a shakeout below, back again, but then we ran into this declining black line. That's the dividing line between a healthy and a risky market. And big move down off of the highs after that gap up on CPI last Tuesday, 4 additional days down. Now finally a consolidation day. at the bottom of this range. Really an anemic bounce if you're a bull. Just, I mean, nothing to it. Light volume. It is the holidays, but really a pathetic bounce. So where does that leave us? Well, let's go through the rest of the indexes. Same situation, even worse though for the Nasdaq, as it couldn't even finish positive today, and that's because Tesla down 8% on the day. People just running away from that stock almost in a panic manner now, more than 50% off of its highs. How about the Dow? Dow holding on to its 50-day moving average, which is just above the 200-day moving average. So very clearly still the most healthy of the indexes. Mid caps below, declining 21, declining 200, flattening but still uptrending 50. Three closes below the 50-day now. IWM small caps, four closes below the 50. The 21 getting ready to cross below the 50. That's normally a bearish sign. 200-day moving average still pointing down. Relative strength line pointing down. No love in small cap land. We are oversold. You know, we've been oversold for a week and a half here. You can stay oversold for 2, 3 weeks. Sometimes if it's severe like here, you stay oversold for 4 or 5 weeks. Uh, Tough to make progress when you're below the moving averages and they're sloping lower and we've got a recession in the headlights. We'll recover in the indices before the recession ends, but it's not clear when. Will it take a Fed pivot on interest rates? Will it take some economic data that shows the recession won't be as bad as it is? The market seems to not be as concerned anymore with inflation as it was, but recession is the topic at hand now. Let's take a look at the equal weight indexes in line with the S&P today, up 0.1%, below their 50-day moving average now. QQEW, equal weight Nasdaq, yeah, it was positive, did better than the Nasdaq 100, sitting right on its 50-day moving average. How about the dollar? Drives a lot of things and it keeps going lower. It's been oversold here now for 1, 2, 3, 4, 5 weeks, 5+ weeks, making lower lows today. How about the VIX? There's no fear in the VIX. Low, lower, dropped back below the 21 EMA. Slope of that line is flat, but this is not bearish. And again, I warn, if we have a big spike like we've had several times this year, this is going to reflect a big move down in the indexes. Right now, it's just controlled distribution over the last week. A little pause on that today. Some people arguing we're setting up for a Santa Claus rally next week. We may, but for now, we still stand by the view that with the lack of leadership, the indices rolling over, leaders breaking their 21-day moving average, that bounces are opportunities to sell until the market proves that wants to at least get back above the 21-day moving average and then make another shot, make another run at the 200-day moving average. Let's look at bonds, TNX. So we had an event overnight in Japan where they finally pivoted to address rising inflation and let their bond yields go higher. There was some overnight volatility off that. How it impacted us was a rise in yields on the 10-year and the 30-year and a change in trend with, well, a 1-day change in trend. We look for 2 for confirmation. The 21-day is flattening out. So this is saying, at least for now, that the declining interest rates may be paused. Note that we are right at a resistance area here, this basically 36.7 area here, which is 3.67 on the 10-year. So note that we're into some resistance, but we are above the 21. The 30-year TYX gap also above the 21, 21 curling up now, coming off of oversold. You know, the stochastic can run for a while, and it running reflects the price running also. So To me, change in trend on the bond yields today. Let's go to a broad bond ETF, BND. Also change in trend just to the inverse, as you would expect, breaking below the 21, stochastic rolling over from overbought. So this is in line, bond price fall, bond yield up. Uh, Sounds like, and that's, again, one close below the 21, flattening out. Let's take a look at junk bonds. Any fear out there? Not really. It did gap down yesterday, make a lower low today, sitting on this 90 level below the 50-day moving average. So junk bonds did uh, two closes now below the 21. Change in trend there as we ran into the declining 200-day moving average on junk bonds. So again, price down means yield up for junk bonds. Yield up because the market is demanding uh, more yield and lowering price down, yield up. That's the story on bonds. How about gold and silver? This is big change today. So uh, gold and silver stocks have been making a move up, consolidating that move. False breakout last week, pulled back down. This is the furthest we've closed above the 200-day moving average now in gold, with a big 1.7% move up with the weak dollar and maybe a fear trade going on with that reaction to Japan. Dollar down, gold and silver up. Let's look at SLV, even stronger, higher closing high. Never even touched the 21. We got into gold stocks today by an NUGT, which is two-time GDX. GDX got above its 21 today. It's still below the 200, but the way GDX works is the gold stocks move in packs. There's usually not one that is head and shoulders above the others. So to spread the risk, buying the index is often the better move. And when you can get some leverage by buying the two time, that's what we did today. Move above the 21 on it. Uh, AEM was probably the nicest chart that I saw out there, and I really considered buying this. I like how it consolidated above the 21 over the last 3 weeks after this nice move up, nice relative strength move up, but opted to go with NUGT when it came down to buying it. So let's go to the tail of the tape now. We'll look at our focus list and we'll see what's changed here on a macro level. Nothing really, still at the high level. These trends in the headwinds persist. Technicals weak on the stochastic on all of the indexes, the G6, the NASDAQ RSI, dollar below the 21, oversold, has been for a while. TNX change here, now above the 21 with the stochastic rising. Put call neutral at a 0.98. VIX down 4% today at 21.48. Fear and greed at a 38. That's fear. We're operating under the bear case since that FOMC and breakdown last Wednesday. Here's the news. Bank of Japan finally raises rates to strengthen the yen. Stronger yen means weaker dollar, good for stocks. Stocks really didn't take that much advantage of it today, but gold and silver stocks sure did. And address inflation there. So the day count, we went to 4 plus down with one consolidation. Now, can we consolidate for a little while? Can we actually get a decent up day? Or are we just going to consolidate and then make a lower low, which continues the downtrend? We'll see what comes out. We don't make predictions. We do know that the market is in a very risky posture based on the action over the last week. Friday, we've got inflation data coming out with PCE. So expectations kind of mixed coming in today. Negative because we're under the all the MAs, but a short-term bounce likely because of the day count. What we really ended up with was a consolidation day, but the low at 3,800 level holding support, as you can see here, also on the NASDAQ hanging around this 270 support level. The good news that we gap down 0.25%, opened at 3808, down 13 points within the first 15-20 minutes, made the low of the day right away. Quick rally up to 3838, and then just really chopped all day long, closing at 3822. Here's this 37.76 that I want to take note of. That was really the overnight low in the S&P with that volatility out of Japan. So what was strong today? Bond prices, which means bond yields, were lower. Gold, silver, and gold and silver stocks and oils led to the downside. Also, the dollar, uh, ITB, which is builders, IYT, transports, XRT, retail. We'll go over the four stocks that we own. We already went over Nuggets, so we'll go over three of them. And then this is the focus list from our morning call this morning. Everybody chiming in on what they're taking a close look at. We always want to be ready. And everybody has a different view on the market. That's we like to collect opinions on the morning call from everybody. Portfolio, we bought that 2% Nugget I talked about. We also added 10% T-bills as we rolled 5% over that was expiring and added another 5%, raising our adjusted beta from a 0.10 to 0.16, or basically 16% of the risk of the S&P 500. Bottom line, finally a reprieve from selling. Tight consolidation day, this 3800 and this 3813, 3815. A big cluster here of support. And again, tried to break it yesterday and couldn't. We had an undercut and reclaim. Two undercut and reclaims now. We can add 19 and 20. So we did the same thing, undercut it today, reclaimed it. Next level, big level down, 36.62. That's the 200-week moving average. So let's get to what we're still holding in-house and the focus list. Boeing acted great today. Just riding that ADMA higher like a champ, along with the relative strength, looking great. Mobileye down to a 1% size on this, uh, battling right around that 8 EMA, down 3.8% today after yesterday's gains. Just the opposite in TMDX, down big yesterday, but bounced at the 50-day moving average, up 4.5% today. We've got a 1% position in this also. Note it's coming into oversold, and we did get a hook up today. So maybe the combination of the 50-day moving average and the stochastic reflects that it might be time for a little bit of a run on this one also. We looked at Nugget. Let's look at follow up from yesterday, MDGL, this big monster volume gap up on liver drug. Follow up to the upside today. Again, big volume up another 6.5%. We're just watching it for now, not interested in buying it. Halliburton, oil services stocks have been leading lately, and Halliburton showing relative strength over the last week and a half, back above the 21, then a pullback to the 21 and the 50, and a move up off of it today. One of the best looking oil stocks out there. Also, FOUR payment processor. Nice 4-day, 5-day consolidation, 4-day consolidation right above the ADMA, relative strength, uh, looking great over the last 2.5 weeks. Pick, Michael's been on these two ETFs. It's holding at the 200-day in this 40 level. This is basically XME, but without the precious metals. So it's more a pure play on the base metals for metals and mining, and XHB, which gap up failed, holding the 50-day right around that 200-day at the 60 level. What's next? AEHR. This is a wild stock, up, down, all over the place. Finally tightening up a little bit over the last 4 days, right around the 50-day moving average, and coming into oversold. So maybe that's as low as it wants to go. AEHR. They've got the big test systems for silicon carbide semiconductor manufacturers. What's up next? Caterpillar holding strong, not making any progress on price, but definitely on relative strength over the last week and a half, hanging around this ADMA. And really what it's doing is putting in a handle on this big cup. This is just showing a cup base, but because it made a higher high, it's not showing the handle, but theoretically, or in reality, that's what this is a nice 4 to 5 week handle that it's putting in off of that 240-ish level. Two more. First Solar, we were in it. We got stopped out on this sell-off. Sell-off was below average volume. Huge volume on Friday, which somehow was quad witching related, but it was 600% above average volume. Kind of strange there, but it's hanging out right around the 21-day moving average, and it's come off oversold. And finally, TBT. This was an Alex play off the 200-day moving average. He took profits on this today. Uh, Sharp 4-day move up off of there, got above the 21-day. Remember, this market's about selling into strength and buying strongest stuff on weakness, just coming off of oversold too. It might be a chance for a re-entry in that, considering that the TLT broke down below the 21 today. So a little bit of a battle going on in consolidation around interest rates here. We'll see if we can get a new trend established after this uptrend over the last 4 or 5 weeks has been broken. So that's going to wrap it. As always, love to hear your feedback. Don at revereasset.com or my partner Danny Stewart, Dan at revereasset.com, or you can call 855 Real Wealth. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much of that you can keep, and be prepared for the next market rally. Every day that we are not rallying is one day closer to the next rally. I don't know if it's going to be 2 weeks, 2 months, or if it'll be 2 years in a bear market the way we were 2000 to 2002 and 2007 to 2009. I kind of think not, but doesn't matter what I think. Uh, but we've preserved capital. We've done a good job of it this year, and we're ready when the market turns. So reminding you, it's not how much you make, it's how much you keep. So wrapping up Tuesday, December 20th, this is Don Vandenbord, just the facts here at Revere, telling it like it is. We don't care about opinions. Market doesn't care about them either. Price and volume, those are the only two facts in the market. Thanks for listening and have a great day.